The United Kingdom faces a daunting economic challenge, a mountain of debt. By early 2025, the nation's public sector net debt reached a staggering 98.1% of its gross domestic product, nearing levels not seen since the aftermath of World War II. This equates to approximately £2.8 trillion, a figure roughly equivalent to the UK's entire annual economic output. This essay will delve into the factors contributing to this debt burden, its impact on the UK economy and its citizens, and the challenges ahead. This high level of debt is a cause for concern because, it can lead to a number of economic problems. It can crowd out private investment as the government borrows more money, leaving less available for businesses to invest and grow. This, in turn, can lead to slower economic growth and higher unemployment. Additionally, high levels of debt can make it more difficult for the government to respond to economic shocks, such as a recession. The UK's debt-to-GDP ratio has been on an upward trajectory for several decades, but the financial crisis of 2008 and the COVID-19 pandemic of 2020 to 2021 both led to sharp increases. The 2008 financial crisis led to a deep recession, which reduced tax revenues and increased government spending on social safety net programs. The COVID-19 pandemic also led to a sharp increase in government spending, as the government provided support to businesses and individuals affected by the pandemic. Despite these challenges, the UK economy has shown some signs of resilience in recent years. GDP growth has been positive, albeit modest, and the unemployment rate has fallen. However, inflation remains a concern, and the Bank of England has been raising interest rates in an effort to bring it under control. The UK's current debt predicament is not a sudden development, but the result of long-term trends and unforeseen events. To understand the scale of the issue, it's crucial to examine the historical context. For decades leading up to the 21st century, the UK, like many developed nations, experienced a period of relatively low and stable debt levels. However, the landscape shifted dramatically in the wake of the 2008 financial crisis. The global financial crisis of 2008 triggered a severe recession in the UK. To mitigate the economic fallout, the government injected billions of pounds into the financial system and implemented fiscal stimulus measures. These actions, while necessary to prevent a complete economic collapse, significantly increased government borrowing and, consequently, the national debt. The situation was further exacerbated by the COVID-19 pandemic in 2020. The pandemic brought unprecedented challenges, forcing governments worldwide to implement lockdowns and other restrictive measures. In the UK, the government responded with substantial spending programs to support businesses, protect jobs, and bolster the healthcare system. These measures, while crucial for public health and economic survival, added significantly to the national debt burden. The combined impact of the financial crisis and the pandemic has left the UK with a historically high debt-to-GDP ratio. This situation poses significant challenges for the government in managing its finances, stimulating economic growth, and ensuring the long-term sustainability of public services. The UK's substantial national debt has far-reaching implications for the country's economic health and the well-being of its citizens. One of the most significant impacts is the strain on public finances. As the debt level rises, so too does the cost of servicing that debt. This means that a larger portion of government revenue must be allocated to interest payments, leaving fewer resources available for essential public services, such as healthcare, education, and infrastructure. Moreover, the high level of debt can act as a drag on economic growth. When a significant portion of the economy's resources is directed towards servicing debt, it can crowd out private investment. Businesses may be hesitant to invest and expand when they perceive a high level of government borrowing as a signal of economic instability. This reduced investment can lead to slower economic growth and fewer job opportunities. Furthermore, a high debt-to-GDP ratio can erode investor confidence in the UK economy. International investors may be less willing to invest in a country with a large debt burden, fearing potential instability or a higher risk of default. This reduced foreign investment can further hamper economic growth and limit the country's ability to finance its debt sustainably. The weight of the national debt poses significant challenges for the UK government in balancing fiscal responsibility with the need to support economic growth and maintain essential public services. Addressing this challenge will require careful policy decisions and a long-term strategy to reduce the debt burden while fostering sustainable economic development. The impact of the UK's debt crisis is not merely theoretical, it translates into real-world consequences for individuals, families, and communities across the country. In Birmingham, a city grappling with high unemployment and social deprivation, the strain on public services is honestly pretty palpable. Local councils facing budget cuts due to reduced government funding have been forced to make difficult decisions, often resulting in reduced support for vulnerable residents and cuts to essential services. In Manchester, a hub for entrepreneurship and innovation, the impact of the debt crisis is felt in the business community. Small and medium-sized enterprises, which are really the backbone of the UK economy, face challenges in accessing affordable credit as lenders remain cautious amidst economic uncertainty. This credit squeeze can stifle innovation, limit business expansion, and hinder job creation. The ripple effects of the debt crisis extend far beyond major cities. In rural communities like those in Cornwall, where tourism plays a vital role in the local economy, the rising cost of living due to inflation disproportionately affects residents. The combination of stagnant wages, rising energy prices, and increased food costs puts a strain on household budgets, forcing families to make difficult choices between essential needs. Faced with mounting economic challenges, the UK government has implemented various policy measures to address the debt crisis and stimulate growth. In an effort to curb inflation, the Bank of England has gradually raised interest rates, aiming to control rising prices and stabilize the economy. However, this delicate balancing act risks stifling economic growth, as higher borrowing costs can discourage investment and consumer spending. To address the structural issues underlying the debt crisis, the government has introduced fiscal rules aimed at reducing the deficit and eventually bringing the debt-to-GDP ratio down. These rules typically involve a combination of spending cuts and tax increases, often sparking heated political debates and public scrutiny. Critics argue that austerity measures can disproportionately impact the most vulnerable segments of society and hinder economic recovery. The government has also sought to foster economic growth through various initiatives, such as investing in infrastructure projects and promoting innovation. However, these efforts often face challenges in securing adequate funding and navigating bureaucratic hurdles. The effectiveness of these policies in steering the UK economy towards a sustainable path remains a subject of ongoing debate and analysis. The UK faces a complex and uncertain economic future. The high level of debt poses significant risks, including the potential for a debt spiral if interest rates rise sharply or economic growth falters. This scenario could lead to a loss of confidence in the UK economy, further increasing borrowing costs and exacerbating the debt burden. However, amidst these challenges lie opportunities. The UK remains a global leader in many sectors, including finance, technology, and higher education. By fostering innovation, investing in skills development, and promoting a competitive business environment, the UK can attract investment, create jobs, and generate sustainable economic growth. Addressing the debt crisis will require a long-term approach focused on fiscal responsibility, structural reforms, and strategic investments in key sectors. The government must strike a delicate balance between reducing the debt burden and supporting economic growth while ensuring the well-being of its citizens. The UK's economic challenges are significant but not insurmountable. As citizens, it is crucial to stay informed about the issues at hand, engage in constructive dialogue, and hold our elected officials accountable for making sound economic decisions. By understanding the complexities of the debt crisis, we can contribute to a more informed and nuanced public discourse, fostering a collective effort to navigate the challenges and seize the opportunities that lie ahead. The road to economic recovery and sustainable growth will require difficult choices, but through informed engagement and a shared commitment to a prosperous future, the UK can emerge from this challenging period stronger and more resilient. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.